How did the gold standard impact historical inflation rates? Imagine a world where the value of money is tied to a fixed amount of gold. That was the essence of the gold standard, a system used by many countries in the past. This system had a big effect on how prices changed over time. It kept inflation low over long periods but also led to some sharp ups and downs in the short term. When a country was on the gold standard, the amount of money in circulation was directly linked to its gold reserves. If gold reserves grew faster than the economy, prices would rise, causing inflation. But if gold reserves grew slowly or shrank, prices would stay the same or fall, leading to deflation. This link made governments less able to print money freely, which helped keep inflation in check over many years. During the period from about 1880 to 1914, known as the Classical Gold Standard era, inflation was very low. On average, prices only increased about 0.1% each year. That means prices stayed quite stable compared to the high inflation seen after World War II. Still, even with long-term stability, prices could swing a lot in the short run. The United States, for example, saw frequent price jumps and drops caused by economic shocks and changes in gold flows. The gold standard also limited what central banks could do. Because the money supply depended on gold, they could not easily lower interest rates or expand credit to fight economic slowdowns. This made it harder to recover from downturns and sometimes caused long-lasting deflation. During the Great Depression, countries on the gold standard struggled to respond to falling prices and economic decline. They could not devalue their currencies easily to boost exports, which sometimes led to protectionist policies instead. Sometimes, countries faced speculative attacks on their currencies, which could force them off the gold standard suddenly. When that happened, it often caused abrupt contractions in the money supply and worsened economic problems. Overall, the gold standard kept inflation low and stable over many years, but it also made economies more vulnerable to shocks and deflation. It limited how governments and central banks could respond to economic changes, which is why modern systems prefer controlled, low positive inflation. Understanding this helps explain why central banks today actively manage inflation rather than sticking to a gold-backed system.